So, hello everybody, here we go for another one of these Substack videos. So, as usual, no trade calls, no recommendations, or responsible loan stuff here for educational purpose only. What I wanted to do was just to revisit SPX. It's been a very interesting start for the year. Again, I'm not going to pontificate or go through whatever's happening. That's for the webinars or for the Twitter feed or for the Substack chat. Here, I just want to look at it purely technically to give you some reference points on what I'm focusing on SPX. So right here, we had, just a reminder, we had that big, what we call the Friday range, the Trump tweet range, where we had a little bit of panic, which was essentially the main reference point, all the way through into the back end of the year, where the market popped out. We started to have the lower highs and we closed back inside it. And this is where, once we moved back inside, the bears had a real chance at forcing some downside traction, clearing the bottom side of this range and forcing a deeper correction. Now, what happened is that range still held solid with that hold of those lows. So the range trade continued. We went back into those highs, popped above. We had a little bit of sideways action. Once we came back inside, market still holding that series of higher lows, holding the breakout. And again, high, higher high, higher high, higher low, and we're going to take out that 7,000. Now, clearly what was concerning is that normally it should have been very, very easy for the market to take out that 7K mark, especially into expiration, and the market couldn't, and we started to trade very heavy. And there you can see how the market started to look much heavier, right, with repeated negative closes, so close to that 7K mark and repeatedly closing negative. Even here on the gap down, bulls came in, bought it aggressively, defended the 2026 open price, tried to jack it back higher. And again, it's showing you a market that is weak, right? That is weak, that is tired. And especially with this kind of action into OPEX, you expect it to come right back down. And at the very least, challenge this low, the stick save at the 2026 open. So here what happened, we cleared that 2026 open, we cleared the 50-day moving average from a closing basis. So where do we go from here? I think a lot of people also will just be focused on the 100-day moving average and the 200-day. What I would like to highlight here is that, keep in mind, nothing much has happened. From those all-time highs, we've had a little bit of a pullback, but essentially we're down not even 3%. So as just a reminder, 5% pullback usually happens 3 to 4 times every year. So, you can call it once a quarter. We usually get a 10+% correction every year too. So really, this is not even a flesh wound. Now, clearly, the fact that this has broken this structure, even if you just look at it in terms of this kind of wedge, the way these things tend to resolve is they tend to go back all the way into the scene of the crime, back into the bottom of the wedge. So despite from intraday trading purpose or intraday trading dynamics, obviously it makes sense to know where the 100-day moving average and to keep an eye on that. Bar any tweet or anything, because of course you get a tweet, this could be back through 7,000 in a second, you never know. But technically what I would be focused on, I would still prefer to, from a bigger picture view, not necessarily focus on the 100-day, but focus on the still on that Friday range. Now, you could argue splitting hairs because that 100-day is coming in pretty much in line with that top end of the range. So, you could look at it the same way, but that's what I would be focusing on, right? Going into here, into this week, into earnings, into possible scouts hearing, into core PCE data. That's going to be the key. Right now, remember, because of the way we've traded here, velocity of the move to the downside, and always you'd expect that to be much quicker than to the upside, so you can get an air pocket. But I think this range is really key, and especially if we can't bounce through it very, very quickly, I suspect that the market has unfinished business at these lows. Now, what's interesting here is also the 200 DMA is slowly converging, coming back in line with that range. So I would still prefer, even though a lot of pundits are going to be looking at the moving averages, I would still prefer to continue to have this Friday range up and use that as a reference point. Why? Because in general, I prefer horizontal levels, which are fixed, which are non-negotiable, not debatable, not subject to interpretation, than the 200-day moving average or any moving average, which is a little bit more dynamic, but it can be a little bit messier in terms of also trying to interpret hold or not. I prefer horizontal lines. So going forward this week to the downside, that's really the focus. Now, in the bigger scheme of things, I would hazard this guess. I would say I would call anything that stays inside this range neutral. Pretty much to do about nothing. No cause for concern at all. Okay. And structurally or bigger picture, any hold outside of this box, then you just have to assume that this was just a little bit of a fake out, a little bit of thin liquidity chop. The market is going to regain its footing and things turn back bullish for an attempt to clear that 7,000, because, it just seems too strange that we have a sustained down move without clearing that number yet. And on a day close, weekly close below that range low, and especially if it takes a while to do that, that's probably also going to clear the 200, then that becomes very bearish. And your base case expectation is that we have to unwind all the way back into these previous highs close to the 2025 open. A lot of people will be looking at it in terms of what is the 50 back of this move from the April lows into these highs. And you can see that the 50 back is coming in pretty much with that 2025 open. Now, from those highs, that 2020, the beginning of these previous highs is about 12% away. That is 15% away. So again, on average, that tends to happen every 2 years or something. So it's not a crazy move at all. And you wouldn't be concerned for the bull market or anything. That would just be a little bit of a correction. But again, summary going into the rest of this week, this is a very neutral zone here. If we start trading below, then your base case is we have a lot more to unwind, probably, close to 300, 400, 500 points lower. And as long as we can stick save it here, then this continues to rotate higher with tech earnings coming in, and it's going to try to continue to take out those highs. Personally, the action right here looks like at the very least we have to move back into that neutral zone, and then we'll have to navigate headline risk, earning risk. But right now, it just market's behaving very technically exactly what you would expect to see. So let's see if this gets interesting. Okay, wishing everybody an awesome one. All the best. Talk to you guys soon. Take care. Bye-bye.